The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your hosts, the AFC team, Mike and Al, are registered investment advisors who have a proven track record of managing long-term investments surpassing the markets. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's your AFC team, Mike and Al.
And it is Saturday, and Al is gone today, but I am here and without a guest today. But I thought I would share with you how we developed the value proposition. Our value proposition is that we want to create, and we have a passion for creating wealth for our client. It took a couple years to get there, and the industry from the time I began in 1986 has changed. And let me take you through those changes and tell you what's gone on and why things are very different today from what they were in 1986, and how that has changed and evolved in this industry and what we do since I licensed in June of 86. And actually, the whole industry changed in the early 70s with the telephone and with telephone solicitation. It was from the 70s, and by the time I got into the business in 1986, June of 1986, the way in which you build your book if you were a stockbroker, back in those days, we were stockbrokers, not financial advisors. That would come later. But the idea was to make a lot of dials. And my goal every day was to make 100 dials, to talk to 20 people, because a lot of people didn't answer the phone. The phone went to voicemail, and there wasn't very many voicemails in those days. And of those 20 people, to find 5 prospects every day, and to open one account for every 20 prospects. I actually opened almost 2 accounts for every 20 prospects. But that was my shtick. That's what I was doing. And the idea in those days was that most investors who had any wealth would have 2 or 3 or 5 or 6 or 8 different stockbrokers. And if you didn't make money for the client, they'd go elsewhere. Lose money a couple years in a row, and they might walk away. They were constantly in a state of flux. When I got into the business, the average turnover for financial advisors was 20% per year. 20%. Today, it's down under 5%. But in those days, it was 20%. And because we were dealing with people who didn't have as long a lifespan in the 1980s, about 5% of your clients would die every year. So that meant that 15% moved. Some would move because they moved out of state, or they moved out of your location. But about half of the people moved because they were enticed away by another stockbroker. And they had accounts that just moved from place to place to place. And that's where we began. That's where it went. But back in those days, I was trying to develop what I wanted to do. And it was, in those days, it was being a stock jockey. Every month, pick a new stock, talk to people on those cold calls, build a position. You might build 10,000 shares in a month, and then move on the next month to a new stock. And then the next month to a new stock, and the next month to a new stock, building a position of 8 or 10 or 12,000 shares every month until the stock hit a target price. And then you'd sell that position out and move that into the current month. So you would now have 20 or 25,000 shares. And the next time it rolled over, you would have 30 or 35 or 40 or 50,000 shares. And each time you sold, you were making a transaction fee, a commission. You make a commission on the sale, you make a commission on the buy, and through that period, you build large positions. But I hit a point where there was one stock I did not want to sell. I became so infatuated with this one stock, I didn't want to sell it. Even when it reached my target price, I kept holding on to it. And at the same time, I was doing a study. I wanted to know what great investors there were. And just arbitrarily, with a undergraduate math degree, master's in business, but an undergraduate in math, I decided I wanted to know who produced 20% per year returns for a period of 25 years. That would turn a $10,000 account into a $1 million account if you could achieve 20% for 25 years. And during those times, I would get all sorts of articles every week, or books, or TV programs from time to time that would talk about great investing and how to make money in the stock market. That was a big thing. So I came up with a mathematical definition of what a great investor was, and that's someone who would produce 20% per year for 25 years. I didn't know if I was going to find 1,000 money managers who could do that, or if there'd be no one that could do that. And what I found actually was a very limited number of investors who could do that. Warren Buffett, almost everybody knows Warren Buffett. But there was Roe Price who did it. John Templeton did it. And Philip Fisher had done it. I liked Peter Lynch. He had done it for 13 years. And even though it wasn't a 25-year time period, it was significant. And he had written a book called One Up on Wall Street, which I read and thought, this really is something that can form the basis of moving around and developing. But shortly after I arrived, I licensed in June of 86. In October of 87, there was a major turning point in the market. That was Black Monday. The market tumbled 500 points, 33% in one day. I was so infatuated by what was going on. I sat all day long. I didn't make my dials or my contacts. I just sat and watched the market cave in. Every time it started to rally, it would just fall off the cliff again. And when it was all over with, when that day was all over with, what happened to the brokerage firms? And in those days, most people were in the big brokerage firms or regional firms. What happened to those firms is trading dropped off a cliff. Their trading revenues took a huge dive. And each one of the firms came up with a different approach. I was working for Payne Weber. They came up with a 6-month annuity, paying 7%, no surrender charge, no other fees, no fee, no commission to the financial advisor. Someone put $100,000 in, they got $100,000 out plus their 7%. They could take it out at any time. And the idea was just to keep the money at Payne Weber so that when people began to feel confident again, you could move the money out and start trading again. That was the Payne Weber approach. They did pay the stockbrokers a commission, but that was a loss leader for Payne Weber, looking toward the future. Prudential Securities came up with a different approach because Prudential Securities found that the average stockbroker was creating 5 or 6 or 7% in fees. That was the average turnover. They were buying and selling so often. They were creating 5% of fees. And so Prudential came up with the idea of charging a fee. You could do 1,000 trades a month and only pay a fee of 3%. So it was a big gain for people who were trading a lot. And that way it kept the revenues at Prudential Securities and it continued to generate revenue. That was to have a significant impact later on down the road. Merrill Lynch came up with probably the best approach that is still in existence today. They came out with the idea of doing financial plans. Now, prior to Merrill Lynch, most of the financial plans were being done by taxi drivers and butlers and doormen at hotels, piano players in a piano bar. Financial planning was not very widespread, but Merrill Lynch came up with the idea that every financial advisor, every stockbroker had to do one plan and charge a client $245 to do the plan, or they would drop the payout to 25% or something of that nature. Most stockbrokers were getting 40 to 42, maybe 38% payout. Their payout dropped to 25% if you didn't do your financial plan. And the concept was by doing the financial plan, you could go out and if a person had 6 different accounts, you went out and you found out what they had in all those accounts and you said, if you consolidate these here at Merrill Lynch, we'll do a financial plan. We'll charge you $245. We'll set up goals. We'll do all these things. And that was the Merrill Lynch approach. And it was extremely successful. They kept moving accounts in. All this idea that you can avoid the willy-nilly rush by bringing all your assets into one place. And it was so successful that any account that was less than $30,000 was sent to a central calling center. And when all the other firms began to see what Merrill Lynch was doing, they decided to add financial planning too. And from that $245, it eventually became almost a free service, and everybody began to do financial planning. That was the launch. It was not in the client's best interest. It was in the best interest of Merrill Lynch to bring the money into Merrill Lynch so that they could manage it and they could generate income from the money that came in. It was to shut down the outside accounts and bring them all within the Merrill. That is where things stood for a period of time. In 1990, I wanted to go through a change. I wanted to go fee basis instead of transaction basis. I told you that I had one stock I just couldn't sell. That stock did extremely well. There's other stocks that have done like that. That's what I wanted to do. In 1990, I left Payne Weber and I went with Dane Bosworth because I could start to do fee business. Come back to this and tell you more about it. We have a passion for creating wealth. I'll tell you why as we go along.
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So I started this program by saying I wanted to explain our value proposition because our value proposition, in summary, is we have a passion for creating wealth. And we do that, and that's a process that's grown. But as that's happened, the industry has changed around us. I mentioned after the crash of 1987 that Merrill Lynch went into financial planning, and that has swept up the industry. Swept up the industry because the idea is to consolidate accounts. Prior to 1987, everyone had 6 or 8 accounts. And if you didn't make money for people, they moved to somewhere else. Merrill Lynch came up with the idea, consolidate the accounts, and then they don't have a comparison. When you have all your eggs at one place, you don't know if you're doing well or poorly. It was a beautiful thing for Merrill Lynch, not so much for the clients, but that's another story anyway. So I left Payne Weber, where I was from 1986 to 1990. I left Payne Weber to join Dane Bosworth because Dane Bosworth was just launching their fee-based business. Instead of commissions, to charge a fee. Now, it was not an easy transition. A lot of people had been used to paying transaction costs, commissions, for 20 or 30 years. They saw the business as a transaction business. Every time you do a trade, you pay for it. Every time you buy or every time you sell, you pay for it. This idea of a fee, why would you want to pay a fee? And the fees in those days were 3%. 3%. Today they're at 1%. But that's another story. We'll get to that too. The idea was because it worked in the favor of the client, you could do any number of trades and still only pay 3%. If you did 100 trades a month, you could still just pay a single fee. But for me, it was also the thing that instead of being a stock jockey and building a position and selling stocks, I wanted to be in a position to get paid for keeping someone in a stock. Way back in 1972, long before I got into the industry, 1972, I paid about $10 for a share for a stock of a company called Advanced Micro Devices. Still around, still doing well. But at that time, it was on the NASDAQ. It was an AMDV was the symbol. Now it's AMD. But back then it was AMDV. I paid $10, and that stock went within 6 months to 30. I was so excited. I sold the stock. I tripled my money in 6 months. And it wasn't until in the 1980s that I really looked at what the stock had done since I'd sold it. And I found out if I'd kept that stock, instead of being at 30, when you adjusted for splits, that stock per share had gone from $10 to $1,756. I had been so happy to triple my money. I was so defeated when I found out what I could have made on that stock. And that set in my mind, I should get paid for keeping people in stock over the long term. And that was not just my concept. It was the same thing I'd found for the great investors, whether it was John Templeton, Roe Price, Philip Fisher, or Peter Lynch, Warren Buffett. They all kept their stocks for a long time. And from that, as I got to Dane Bosworth, I developed what I call my 3 principles. There's 3 principles I look at in managing a portfolio. Number 1, I want stocks that have twice the upside as downside. So if you buy a stock for $10, I want the upside, if it's got an upside, to go to 20, if I think it can go to 20. And if it's got a risk of going to 5, it's got a risk of twice the upside, $10, to downside, $5. If I buy 3 of those stocks, each one at $10, my total out-of-pocket cost is $30, right? 3 times 10. If 2 of those stocks fail If two of those stocks go from 10 to 5, I've lost $10 for those two stocks. If the other stock succeeds and goes from 10 to 20, I have a break even. I only have to be right 33% of the time to break even. And even if I'm right 50% of the time, I make a lot of money. So that was the first principle, is to understand that. And I want to explain, I'm a mathematician. And so everything I do is mathematically oriented. So the second principle was game theory. And this is more complicated. But I set up, if you play a game where you start with $100 and you have 100 plays, and every time you bet, you can bet a different amount, but you have a 50-50 chance of winning or losing. But every time you win twice what you can lose. So if you bet $1 and you win, you get $2 back. If you lose $1. 50-50 chance of winning and losing. And there's a couple ways to play. You can bet $1 each time and play it 100 times. And when you work it out, the first time you win, you get 102. You bet $1, you lose 101. If you work that out 100 plays, the expected value is 150. So that's one way to play. The second way to play is to bet $10 or 10% of the portfolio. So the first time you play, you bet $10 and you win, you now have 120. 10% of 120 is 12, so you bet 12 and you lose, you have 108. And if you play that out 100 times, the expected value is 4,700, not 150, 4,700. If you bet, and by the way, math is commutative, so if you work the other way, if you lose the first time, you bet $10, you lose, you have $90 left. 10% of $90 is 9. You win, you get $18 back, you have 108. Same as either way. It doesn't matter the sequence, how it works. If you bet 25% of the portfolio each time, the expected value after 100 plays is 36,000. So if you bet $1, 150. If you bet 10%, 4,700. If you bet 25%, it's 36,000. But that is the optimal. Because if you bet 51%, you lose. If you bet 100% the first time you lose, you're out of the game. So what that says is you need to have only four stocks to optimize the upside in a portfolio. That was the second principle. Third principle is there was work done by William Sharpe, who won the Nobel Prize, and I read his article, and I found that there were studies that were done, and they were done not by Sharpe, but by other people that said that there was, if you take stocks and look at the risk versus the number of stocks, there's no statistical difference on downside of owning 8 or 9 stocks as there is 300. No statistical difference. So what that said is portfolios with 8 or 9 or 10 stocks are concentrated, so they're closer to the 4, but they also have as much diversification as 300 stocks. Now, maybe that's slightly off. I don't know. We're seeing during this period of time that our standard deviation is much higher than the Standard & Poor's. It hasn't been up until the last 3 years, but up until then, it held pretty well. So those were my 3 principles. I came up with those in 1990 when I began to do fee-based work. I opened my first fee-based account on December 31st, 1990, and I've been doing it ever since, and that's the same strategy. Now, that's the kind of approach in terms of mathematical principles, but it also depends upon choosing stocks. And I decided there were 2 types of stocks that I really, really liked. Actually, there's 3, but 2 types that I really liked. One was where the company had a positive cash flow and the cash was greater than the market cap. So they had more cash on their books than if you liquidated the entire company and sold the stock at the current stock price, that you would have more cash than the stock was worth. And in my whole career of 38 years, I've only seen 2 of those. And they were marvelous stocks. I mean, one stock, I raised the question, and it went on the conference call. I raised the question. I said, why don't you just pay a cash dividend? I bought the stock in the 2s. It was selling for 2 3/4. They had almost $4 a share in cash. And I raised the question, why don't you just pay a $3 dividend? Well, suddenly everyone listening to that phone call looked at the stock, and within 2 weeks, the stock was over 10. And I quintupled my money. Now, I held the stock for 6 months, so it wasn't an immediate, but that was a wonderful stock. There's not very many of those. So the second type of stock I like has 4 characteristics. One, they have a squeaky clean balance sheet so that they don't owe any real debt. They're essentially growing the company from earnings. And there's three ways you grow a company. You grow it by earnings, by selling capital stock, or by borrowing. The easiest way the best way is if it earns its growth. Squeaky clean balance sheet. Second thing, they have a franchise on their market. They dominate their market. You can think of companies like Starbucks or Microsoft or some of the other companies, Kleenex. They have a franchise on their market. The third thing is a high inside ownership, so that the founders have a lot of ownership. They have an incentive to see the stock price up. And fourthly, very few analysts, because if you have 90 analysts following a stock, there's not very much information that's missed. But if you have only a couple analysts, you can find things about those companies that very few people know about. They're harder to find these days because there's more and more analysts, but there's still an excellent stock. And the third type of stock happens during times like the Great Recession, or happens during this time when we've seen the market down, which are recovery stocks. Stocks that may not fit the criteria above that I've talked about, but have been beaten down, have been beaten up, crushed, and they tend to recover as the attitude in the market begins to change. Those were the stocks. And that's the philosophy of what I started with in 1991 and have carried through for this period of time. So we'll come right back, because what's going on in the industry? I've given you a lot of thoughts about Adams Financial Concepts. What's going on in the industry and where do we stand? Don't go away.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's your AFC team, Mike and Al.
So I've been talking, our value proposition at Adams Financial Concepts is we have a passion for creating wealth. And it goes beyond that. But that's essentially our value proposition. We want to create wealth. But if you look at where we are, we're a very tiny fish in a very big pond. There's a lot of people with a lot more money, with a lot more staff, with a lot more resources than we have. And so looking at things on a normal basis, we're at a very competitive disadvantage. I mean, you have the firms, the big firms, like the big brokerage houses, the Merrills, the UBSs, the Morgan Stanleys, who have dozens and dozens and dozens of research analysts. They may only cover 5 or 6 stocks and the industry, and they have a lot of time to devote to that. We not only have to do our research, we have to do it along with managing portfolios. So we're at a significant disadvantage to the regular financial advisors. And by the way, one thing I should add, in 1987, we were stockbrokers. When the market crashed like it did, and I talked about that earlier in the program, but when the market crashed like that, stockbrokers became the bottom of the ocean. You know, the thing went around, how do you tell when a stockbroker's lying? His lips move, you know. If 90% or 95% or 99% of the stockbrokers died, it'd probably be a good thing. All those jokes went around. So the firms started playing. They don't like compared to a stockbroker, used car salesmen looked like blue chip salespeople. I mean, that was the world we lived in 1987. We were the scum of the earth. And so to change that, the big firms began to require, number one, a college education. Then they began to change the title. And I think it was Merrill Lynch that came up with the title of financial consultant. And other firms came up with different titles. And eventually it coalesced into financial advisor. And that fit. The other ongoing thing that was happening is, as I explained in the first part of the program, the industry began to move toward financial planning. That was where the industry was going. It was, for the firms, a chance to bring together all the different accounts that were outside the firm. And in those days, most investors had 2 or 3 or 5 or 10 different brokerage accounts. This was a chance with financial planning to bring them all in-house, not allow people to have a comparison so they didn't know if they're doing well or poorly. That's true today. They don't know if they're doing well or poorly. And by doing that, they brought the money in-house and they kept that money and they kept the industry going that way. That's where things were going. That's what was happening. But at Adams Financial Concepts, we're at a competitive disadvantage. And the quants, I mean, you think of the Ray Dalios and the other quant programs where They have $100 billion in assets, and they have computer programs, and they analyze, and the computers analyze things so fast. I once had a guest on the radio program who had written an algorithm, and it was just for peer-to-peer lending. But that peer-to-peer lending on Thursday afternoons at 2 o'clock, Lending Tree announces all the loans that they've generated, and they sell those to whoever wants to buy those. He'd written a program for it, and he had his own investors, and that program would go in at exactly 2 p.m., look at every one of the loans, would rate the quality on every one of those loans, would then organize those loans, and if he had, I don't know, several $100,000, it would buy several $100,000 worth of those loans. It would then repackage, separated them into 10 or 12 loans per package, and each package $1,000 or each bond $1,000, and then allocate that to his investor. And they did all of that in less than 1 second. By the time you or I could look and read the first title on one of those loans, it was gone. The best ones were gone, and you got what was the dregs which were left over. That's what the quants do with all that information. They look at tweets, they look at all the information. They can process huge amounts of information with a computer and package that and then do the trades by computer. 65% of the trades made in the market today are made by computers with no human intervention. They do all that. So that's how they built their success. That's how they succeed. We don't have that. We have a couple guys sitting down and doing our own research, and we've been successful at doing it. So what do we do? Number one, we look at 30 to 40 stocks every month. We don't do an in-depth analysis. We just look at 30 or 40, and from that we find 8 or 9 where we actually look at the financials on those. And then from those 8 or 9s, we drill down and read the 10Ks and 10Qs of 1 or 2. And then we only do 1 or 2 trades a year. That's our strategy. Not only that, we're not looking for what the stock price is going to be in a week or a month or a year. We're looking for a long term. I told you, the investors who were great investors, John Templeton, Roe Price, Warren Buffett, Peter Lynch, Phil Fisher, those who were the investors who produced a 20% for 25 years, except for Peter Lynch, who was only 13 years, those investors bought stocks and they bought them for the long term. We're looking for long term. If we have a big drop, we know that stocks are going to go up and down, and there's going to be drops, sometimes calamitous drops. But we're looking for the long term. We're looking for the stocks that are going to succeed. We're looking for emerging trends, things that are happening, auto driving, AI, alternative energy. We're looking for things which are changing in technology, demographics, and lifestyles. If someone would have said to you 20 years ago that you'll take a trip somewhere, you'll get off the plane, you'll get into a stranger's car who will drive you to a stranger's house where you'll stay, whether it's business or for pleasure, you would have laughed at them. But you know, the 2 largest taxi companies in the world the taxi drivers own those. The taxi companies own not a single taxi. The largest hotel chain in the world does not own a single hotel. The largest media company does not own any media. That was the trend that was happening. If someone would have told you in 2019 that we were going to have a disease which would kill over 1 million Americans, kill almost 7 million people worldwide, and do that within a year, you would have laughed. But we had a pandemic. We're looking for things that are changing in technology. I mentioned advanced micro devices. They were doing random access memory chips back in 1972. That was a radical change in what was going on with small computers. And the small computers were arriving in the market. Up until that time, the computers had been almost the size of a full room. Advanced micro devices with random memory chips was making it possible for computers to get smaller. That was a significant change in technology. In lifestyles, back in 1966, there was a little company that came out that would change our eating habits. It was a company that was selling 16-cent or 19-cent hamburgers. Drive up to this place. There was no sit-down place at the time they came out. It would change lifestyles. Up until that time, most restaurants had sit-down places, and most of the times when you went out to eat, you would go out for a special occasion, an anniversary, a birthday, a wedding, something that was very special. Not anymore. Now you could go out and for 35 or 40 cents, you could buy a meal at a drive-up place. You had to eat in your car. That's okay. Or you had to take it home and eat it at home. It's okay. McDonald's changed the world. Or look at what happens when you start building a bigger box store. That too happened in 1966. Bigger box stores, sourcing materials from all over the world and especially from China, building out box stores, bigger stores, not the corner stores, not the Sears and Roebuck mail order, but real stores. Even as they developed even the blue light special at Walmart. Those were changes in demographics and lifestyle. That's what we're looking for. Those are things that we're looking for, the long-term trend and the companies which are going to benefit from that. It's a limited number of stocks that are out there, and yet there's a significant number of those. That's where our focus is. That's not a focus of the quants. It's not a focus of the big research department. It's not a focus of where people are. Most of the big firms are looking for short-term returns. Think about it. If a company misses the earnings by 1 penny in their earnings, if they make $2.30 instead of $2.31, the stock can drop 15%. That's crazy. That's idiotic. I mean, a stock misses its earnings by 3% and it drops 20%? No way. But that's what world we live in. We're happy about that. We're happy to see those kind of things happening because those play. We're looking for stocks that have the right price at the right time. That's where we want to be. We have our own strategy. We have our own philosophy. And it's been working for a long time. It's been working for 20-some years, 30-some years. I get my math right. And until that changes, we're going to continue to do that. So we're going to come back. Our value proposition is have a passion for creating wealth. Don't go away. I want to talk about where things are headed as well.
About Money with the AFC team, Mike and Al on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've been talking about the value proposition at Adams Financial Concepts, and I've given a short version of it. Our value proposition is that we have a passion for creating wealth. But it goes beyond that. We work with clients who do not accept the average, who want to minimize taxes, who want to take care of their heirs, and who want to make a difference in the world. Those are the clients we're looking for. And that's what we focus on. I've gone through a lot of how we came to where we're being, but I want to talk about the changes that have gone on the market. I talked a lot about what happened in 1987 and how that happened. And as the whole fee thing began to evolve, it hit a downturn in 1994 because clients were looking at their fees when their accounts went down, and they wanted to switch back to commissions. I mean, it was a tough thing to sell anyway, to say, why don't you pay me a fee? Pay me 3% per year for managing your account. It was already tough, but then when you had a downturn, the client would ask, why do I want to pay you a fee when I'm losing money? So I actually had a couple clients that switched from fees to commissions. They looked at how much they paid the previous year in fees, and then they looked at what the commissions would have been, and I told you how infrequent we trade. Said we want to go back to a commission. Following year, we were on commissions. They compared what the fees were to the commissions, and they found the commissions were more than the fees. They said, we want to go back on fees. We went through that process with one client from commission to fees to commission to fees to commission, and finally back to fees, and stayed with fees for the remainder of the time. But it was a tough thing. And when fees were there at 3% and values went down, customers began to raise the question, why am I paying you so much when my account loses money? And what began at that time was a race to zero. People began to lower their fees. And the fees today are around a little over 1%, 1.04, 1.05%. It was a time in which many firms were lowering their fees to keep their clients. The second thing that happened with financial planning and with the concept of charging a fee is financial advisors began to see that they needed to meet with their clients to explain why they were paying a fee, even though their accounts were losing money. I have to say, I never got into that mode. We charge a fee. We charge what I consider a very fair fee. I think Warren Buffett said it the best. You don't pay a 350 hitter what you pay a 150 hitter. Putting it in baseball terms, and if you listen to the program, you know I like baseball. We do very, very well for our clients over the longer term, and we look at the longer term, and that's where we are. But fees began to shrink down, and I believe the financial advisors did one other thing which caused problems, is they began to look at the research that showed performance of mutual funds was affected by the expense ratio and the fees that were being charged. And so passive investing has dramatically increased. Now, when you take the total of all the funds, the 10,000 funds, Fund X did the study and found out of 10,000 funds, there were like 400 funds which outperformed the market, but the rest underperformed the market. And the rest, when you combine 400 out of just 10,000, the 400 don't really make a big difference. And so the fees for the 10,000, it really does count. But for the 400, it didn't matter about how much they charged as an expense ratio. It didn't matter how much they charged for a commission level. Those actively managed funds outperformed the market. But financial advisors, by going passive, took themselves out of the management side and no longer could justify 3%, no longer could justify 2%. The other thing that 1994 did is firms began to talk about sell the relationship, not the performance. Get people to like you. Tell them not to look at how well they're doing. Tell them to look how much they like you, how much they really like you, how much they like the financial plan you've got. And you're planning the rest of their life, financial life. Doesn't matter. 2008 taught us those financial plans, they go gunny bag. But it doesn't matter. If you like the financial advisor, you should stay with him. And it reminded me of a cartoon from 1987. And 1987 had a lot of cartoons when the market went down. We were the scum of the earth. And there's a cartoon of the couple that's meeting with the stockbroker, financial advisor in today's terms, shows the couple and the stockbroker is saying, well, you lost $50,000 and I made $50,000 in commissions, so I guess we broke even. That's what was going on. And there's a movement now. Financial advisors or stockbrokers used to get paid a lot more than financial advisors get paid. Right now, the movement in the market is to pay a salary and a bonus. So there's no real incentive. There's no incentive for doing better. You get paid the same. We've just had a huge problem with Nationwide. Nationwide's on your side? Maybe not. Nationwide is on their side, not on your side. And we had a problem that took weeks to resolve. But the person who works at Nationwide gets paid the same. They could have solved it in 5 minutes. They could have taken hours of my time. It didn't matter to them. They got paid the same. Their check comes every quarter on the same basis. Every week, every month, every whatever they get paid. It didn't matter to them whether they serviced or not. I was livid. I had to go to the head of their compliance to get it resolved. But anyway, that's another story, maybe for another radio program to talk about that. And I'd love to talk about that because Nationwide is not on your side. They are on their own side. But we're moving, as we move forward, to a kind of flat fee. No longer a fee tied to the assets, no longer tied to how well you do. We only do better when you do better. No, it's moving to a flat fee. You just pay us $6,000 a year, and we'll manage your account. If it goes up, it goes up. If it goes down, it goes down. You just pay us $6,000. We're like the post office. We get paid the same. We're just going to mark on our calendars when we get to retire because you're paying for that. That's one of the things that's happening. The second thing that's happening is robo-advisors are coming. Why pay someone a fee of 1% when a robo-advisor can do it for 0.25%? Why pay that amount? And what we're seeing is the fastest growing part of the financial market is in the robo-advisors because people are realizing that what the standard financial advisor delivers is around 5% per year. Even when the market is up 14 or 15%, the financial advisor is delivering a 5% return. Robo-advisors can do that, and they can do it for a lot cheaper, and they can save you money. That's happening. That's where we are. At Adams Financial Concepts, our goal, every time we sign a contract, our goal for our clients is to beat the Standard & Poor's 500 with dividends reinvested. That's what we ask. Our value proposition is we have a passion for creating wealth. We work with clients who do not accept average, who want to minimize taxes, who want to take care of heirs, and who want to make a difference in the world. We know we're going to go through downturns. We know we're going to go through drops in the market. We want a long-term outlook of 5 or 10 years to outperform the market and to build the wealth for our clients. That's where we are. That wraps us up today. Join us next Saturday, because if it's Saturday, we will be talking about money.